The world of finance has always been characterized by its ups and downs, its bull runs and bear markets. Yet, as we stand on the precipice of what could potentially be a cataclysmic event, the question that haunts investors, economists, and ordinary citizens alike is the stock market crash about to happen? In recent times, there has been growing concern that the seemingly relentless ascent of stock prices is unsustainable, and that a severe market correction or even a full-blown crash is looming on the horizon. In this exploration, we delve deep into the signs, factors, and historical precedents that suggest the stock market crash is imminent. Before we dissect the various factors contributing to the impending market turmoil, let's take a closer look at some of the warning signs that have raised alarm bells among experts and analysts. These indicators have become increasingly conspicuous in recent years, fueling concerns that the stock market's meteoric rise is unsustainable. One of the most glaring signs of an impending market crash is the sky-high valuations of many stocks. Price to earnings, also known as PE ratios, a key metric used to evaluate stock price relative to earnings, have reached levels not seen since the dot-com bubble of the early 2000s. The historically high PE ratios suggest that investors are willing to pay exorbitant prices for companies with uncertain future earnings, a situation reminiscent of the irrational exuberance that preceded previous market crashes. Margin debt, or borrowed money used to buy stocks, has reached record levels. When investors use excessive leverage to amplify their gains, it can lead to a cascading effect of forced selling when the market turns south. The 1929 and 2008 crashes were both preceded by excessive margin debt levels, and the current situation has all the hallmarks of a similar scenario. The technology sector has been a major driver of the recent bull market, but many experts argue that it has become a bubble ready to burst. Tech giants like Apple, Amazon, and Tesla have seen their valuations soar to stratospheric levels, leaving them vulnerable to sharp corrections. A significant downturn in tech stocks could have a domino effect on the entire market. The massive government stimulus measures implemented in response to the COVID-19 pandemic have propped up the stock market, but they have also created a potential bubble. As stimulus programs wind down and interest rates rise, the market's reliance on government support becomes increasingly precarious. Inflation is another factor that is causing concern among investors. Rising inflation erodes the real value of investments and can lead to higher interest rates, which can be detrimental to stock prices. The Federal Reserve's response to inflation concerns could have a profound impact on the market's trajectory. To gain a deeper understanding of the impending stock market crash, it is essential to examine historical precedents. Although past performance is not indicative of future results, history provides valuable lessons and insights. The most infamous stock market crash in history occurred in 1929, leading to the Great Depression. Speculation and excessive margin trading had driven stock prices to unsustainable levels, and when panic selling ensued, it triggered a devastating market collapse. Unemployment soared, businesses shuttered, and the U.S. economy plunged into a decade-long depression. The late 1990s witnessed the rapid rise of internet-related stocks, with companies like Pets.com and Webvan capturing the imaginations of investors. However, these companies often had little or no profits, and valuations were based on speculative hype rather than fundamentals. When the bubble burst in 2000, countless tech companies went bankrupt, causing massive losses for investors. In the lead-up to the 2008 financial crisis, the housing market experienced an unsustainable boom, with subprime mortgages at its core. When housing prices began to decline, the financial system faced a cascading series of failures. Lehman Brothers filed for bankruptcy, and the stock market plummeted, wiping out trillions of dollars in wealth and leading to a worldwide economic recession. The lessons from these historical market crashes are clear. Excessive speculation, unsustainable valuations, and financial imbalances can lead to devastating consequences when the bubble eventually bursts. Investors should heed these warning signs and proceed with caution. While historical precedents offer valuable insights, the current financial landscape is unique in many ways. Several factors are converging to create a perfect storm that could precipitate the next stock market crash. The Federal Reserve's monetary policy plays a pivotal role in shaping the stock market's trajectory. In response to the COVID-19 pandemic, the Fed adopted an ultra-accommodative stance, lowering interest rates to near zero levels and engaging in massive asset purchases. While these measures provided essential support during the crisis, they also contributed to inflated asset prices. As the Fed contemplates raising interest rates and reducing its balance sheet, the market faces the risk of a sharp correction. Inflation has reared its head as a significant concern for investors. As the prices of goods and services rise, the real returns on investments diminish. The Federal Reserve's response to inflation will be a delicate balancing act, as raising interest rates to combat inflation could also dampen economic growth and trigger a market downturn. Geopolitical tensions, such as those between the United States and China, can have a profound impact on global financial markets. Trade disputes, tariffs, and other geopolitical factors can disrupt supply chains, affect corporate profits, and introduce uncertainty into the investment landscape. Any escalation of such tensions could trigger a market sell-off. Despite the initial rebound from the pandemic-induced recession, there are concerns about the sustainability of economic growth. Sluggish job growth, supply chain disruptions, and a growing wealth gap are among the issues that could weigh on the economy and the stock market in the long term. Growth stocks, particularly in the technology sector, have been the darlings of the recent bull market. However, many of these companies are trading at lofty valuations that may not be justified by their earnings potential. A reevaluation of these valuations could lead to a significant market correction. In today's interconnected global economy, events in one part of the world can have far-reaching consequences. A financial crisis or economic downturn in a major economy like China or Europe could send shockwaves through global markets, including U.S. stocks. Amidst the ominous signs and looming threats of an impending stock market crash, is there any hope for investors? The answer lies in understanding the principles of prudent investing and adopting strategies that can help weather the storm. Diversifying your investment portfolio is one of the most effective ways to mitigate risk. By spreading your investments across different asset classes, industries, and geographic regions, you can reduce the impact of a downturn in any single area. Carefully consider your asset allocation to align with your financial goals and risk tolerance. A well-balanced portfolio that includes a mix of stocks, bonds, and alternative investments can provide stability in volatile market conditions. Implement risk management strategies such as stop-loss orders and trailing stops to limit potential losses in a downturn. These tools can help protect your capital and prevent emotionally driven decisions. Maintaining a long-term perspective is essential in navigating market volatility. Trying to time the market by predicting when a crash will occur is a risky endeavor. Instead, focus on your investment objectives and stick to your financial plan. Stay informed about market developments, economic indicators, and geopolitical events that could impact your investments. Knowledge is a powerful tool in making informed decisions. Consider seeking the guidance of a financial advisor or investment professional. They can provide personalized advice tailored to your unique financial situation and goals. The specter of a stock market crash looms large in the minds of investors and financial experts alike. While the warning signs and historical precedents are cause for concern, they do not necessarily herald an imminent crash. Markets are inherently unpredictable, and numerous factors can influence their direction. In this uncertain environment, investors must remain vigilant, diversified, and well-informed. Prudent risk management and a long-term perspective can help navigate the turbulence of the financial markets. While the future remains uncertain, the lessons of history and the principles of sound investing offer a guiding light through the stormy seas of financial markets. In the end, the stock market's fate is inextricably tied to the ebb and flow of the global economy, the decisions of central banks, and the ever-changing landscape of geopolitics. As investors, we must adapt to these shifting sands and prepare for the possibility of a stock market crash, while also recognizing the potential for continued growth and prosperity in the years ahead. Thank you for sticking with me all the way to the end. Please like, comment, and subscribe, and make sure the notification bell is turned on so you don't miss a video.